from. We also have Mayuresh Joshi, fund manager of Angel Broking, joining in. Mayuresh, what's the word on the street? I know there's a short covering rally that's currently underway, but I think even now we've got to be cautious. While you can't untake shots on the index, a cautious stance on the market is what is warranted, you think?
So morning, Samina. I think the markets have been cautious, specifically on the mid and small cap universe, because of all the developments that you've probably seen. ASM, the mutual fund churn, margin calls probably getting triggered. So to that bit, again, I think the broader universe is what has felt the heat over the past few weeks. And what has really come out is that the large caps have held on to their own. So a large element in terms of how corporate earnings have panned out in Q4. Earnings ex-PSU banks, ex-telecom, I think still held pretty well. And in that respect, again, you're going to probably look at the June quarter with a pinch of salt, because what you're probably going to see in terms of management commentaries is going to be extremely critical for a few sectors. Having said that, I think the macroeconomic landscape itself, with the rate hike that has probably come through, and though market participants are of the belief that one actually can come through probably next policy meet or after that, considering what is probably happening with crude staying at elevated levels, the MSP hikes, and so on and so forth, I think it's going to be a pass-through for a lot of the companies who probably borrow from the banks. Yes, there will be a marginal increase in terms of their cost of borrowing, but I think it should not substantially impact their NIMs and spreads to have a detrimental effect in terms of earnings profile. So I think the well-capitalized NBFCs, the well-capitalized banks should hold on to their own in terms of earnings growth. And it will be very, very evident in terms of the discretionary trends as well. So I think the discretionary trends specifically on the consumer space, FMCG, staples, where you're talking about autos, two-wheelers, cement consumption, I think that entire basket is going to move in tandem in terms of how the GDP will grow. So the overall corporate earnings should grow between 12% and even to the extent of 14% in the year after that. So an average growth of 12 to 14% not ruled out. So yes, I think there are positive signs in the economy. The stress related to crude, inflation is probably there, but with better monsoons expected, I think at least the food inflation part can get covered. And I think those fiscal concerns might still continue, but the government will go all out in terms of front-loading their capital expenditure. So I think it's a stock pickers market at this point of time, not overly perturbed in terms of the correction that we've seen. Yes, it's a healthy correction in the broader universe, but qualitative stocks within the large and mid-cap space look very, very attractive at this point of time.
Right, that is the view on the markets, and we'll ask some more questions with Mayuresh, but I just want to pull up an Mayuresh, Infosys at a fresh 52-week high in trade right now, 1.5% up. Yesterday they addressed the Morgan Stanley conference as well. Big plans as far as digital growth goes. The new management is taking shape. What's the sense on an Infi right now? And of course, IT sector as a whole has been a marked outperformer, including some of these mid-cap IT names. Would you continue to bet there as well?
So morning, Dipanshu. Again, IT sector as a whole is something that we remained extremely optimistic over the last 3 to 4 quarters. And a strong move has been exhibited in all IT names. So in that respect, again, I think the strategy laid out by Infosys, the kind of expectations that one really has, specifically in terms of the BFSI segment turning around, because I think retail and manufacturing have obviously shown green shoots for the company. And again, the management bandwidth probably getting deployed in the right places would ensure utilization levels remaining extremely high and execution happening at the top level. So again, I think Infosys probably has a long way to go in terms of catching up with its peer TCS, which has probably had a commendable show over the past few quarters in terms of both execution and turning around its subsidiaries. So in that sense, again, it's a whole recommendation that we probably got in the top tier names with the expectations of reasonable growth, both in dollar terms and constant currency terms to come through. For the mid-cap space, obviously, I think stocks like Cyient, Mindtree is something I have liked. They have shown a stellar move over the past 3 to 4 quarters. And again, the expectation and the management commentary surrounding all niche IT companies is stable order flows coming through. They're probably looking at execution being extremely strong. because of their niche capabilities, what you're probably talking and speaking about in terms of them able to continue their earnings momentum is a given. And fourth probably can be the argument towards valuations. So valuations probably a tad bit on the higher side considering the price movements that we have seen. But again, I think if you're probably talking about a double-digit dollar revenue growth over the next 1.5 year, and one actually excludes the kind of impact that one can probably see in terms of wage hikes coming through in Q1, Q2, partially being spread across, the second half typically should also stand out well. So again, the whole recommendations probably continue for monetary side, but we probably like a stock like Nucleus Software on declines, where our thesis is that the kind of capex that they've probably done should start yielding results, and that should probably start showing and reflecting in their earnings over the next few quarters.
All right, so good times ahead for IT. Meanwhile, HCL Tech has also picked up momentum in the IT space right now. That stock is also moving up quite smartly. Mayuresh, any view on these road developers? I mean, of course, the push keeps coming from the government. The road minister is talking about a big ambitious target. You are heading into an election year, so again, infra spending will most likely be in focus as well. Are you betting on them? And also, if you have a specific coverage on a Dilip Bilkon, again, some concerns have come on this stock lately, has seen a big fall, seeing some kind of a recovery right now, but fundamentally, what's the call here?
No, so for road developers, Dipanshu, I think the view obviously remains very positive. What you've probably seen and witnessed in terms of order flows over the past few quarters, I think those order flows will keep on coming through as the government pushes through for further development on this part of their agenda. Having said that, I think the kind of order books that a lot of these road development pushes through for further development on this part of their agenda. Having said that, I think the kind of order books that a lot of these road developers have, I think it's substantial to give them revenue visibility over the next 2.5 years. Now it is the execution that these companies will do which will yield them results. And again, the kind of projects that are actually coming through, specifically on the HAM part, the hybrid annuity model, I think the IRRs there are far better in terms of the traditional POT model. So I think there will be a substantial increase in terms of return expectations as execution starts happening on a fast-track basis for these companies. And it has improved over the past few quarters. Typically Q1, because of monsoons, might be a little bit sluggish, extend that further partially into Q2. But the second half growth can be substantial in terms of execution parameters that these companies can go through. So considering all these factors, yes, I think Sadbhav Engineering, KNR Construction, Ashoka Buildcon still remain very robust in terms of earnings momentum, and they remain one of my top picks. In case of Dilip Bilkon specifically, I think the issues surrounding auditors, so on and so forth, I think it's a little bit overblown at this point of time. When you're probably talking about their order book as well and the consideration in terms of their debt levels inching up, I think one must also consider that the partial proceeds which can come through in terms of the BOT assets that they are or they have intended to sell, and what has come through partially last year, what is expected to come this year, the kind of capex that they'll probably do, and the kind of debt they'll probably pick up in terms of both working capital requirements as well as medium-term borrowings. I think the debt equity level has not overshot. The second element in terms of execution itself, I think execution for all these companies and contractors is going to be on a fast-track basis, because I think it's the agenda and the momentum that the government wants these companies to finish these projects on or before time. Again, I think the run-up to the stock over the past few weeks and months, even before the controversy, was quite substantial. So I think valuations had become very expensive. So to that bit, again, I think the developments are probably getting closely watched. Please hold on to the stock if you have one. Clear disclaimer, I do hold the stock in my funds.
Right, so positive views there. And Mayuresh, what about you? Would you be putting money in the pharma space? I mean, look at a Sun Pharma, for instance. The numbers were good, but the commentary wasn't, and that's why the bounce back in that stock really didn't sustain. Similar is the case with the Dr. Reddy's as well. You saw an 8% jump on the earnings day, but again, it corrected right after that, and now it's back below 2,000 rupees per share. Biocon is only one of those few frontline pharma names that has been outperforming. Otherwise, really, you haven't had too much of an opportunity to make money in pharma. But is this the case now? If this bounce back really does sustain the market, do you think time for pharma has also come?
No, absolutely, Dipanshu. I think pharma was the laggard in the entire market rally, and what you probably saw and witnessed in terms of earnings cut because of pricing pressures that you had probably witnessed in the generic business considering US operations, I think it was getting clearly displayed in terms of how their earnings were moving through. Again, I think to couple that argument, I think the FDA concerns obviously did not assist or help the companies in terms of reporting better numbers as well. So I think both these factors probably had a drawdown effect in terms of the earnings profile for pharma companies. Again, I think there is a huge talk in terms of what can actually happen in terms of expectations of the Trump administration actually wanting pharma companies to take voluntary cuts in terms of their pricing, which again would put additional pressure or continue the pressure in terms of how realizations are expected to pan out. In the same context, we are probably looking at some developments happening in the domestic scene as far as the price capping and the NELM list probably getting extended is also being talked about. So in that sense, again, the pricing pressures might very well continue, and what pharma companies are trying to go through is create a specialty pipeline. So when you talk about a Sun Pharma, a Lupin, a Cipla, Dr. Reddy, they're actually trying to overcome these problems by creating specialty drugs which have better margins and a better market size. So in that bit, again, I think the approvals for the specialty pipelines, the A&D pipeline itself is very, very robust. As and when these approvals start coming through and as their plants become compliant over the next few quarters, I think it's a matter of time that their earnings should start to show signs of improvement along with stability in reported EBITDA numbers. So again, I think the worst in terms of earnings cut is probably there in the price. There might be knee-jerk reaction for these two factors that I spoke about. But selectively, yes, I think pharma does look attractive. So yes, I think stocks like Ipca Labs is something that I'll still continue to prefer. More and less for the domestic formulations business, which is the cash cow. What you're probably talking about in terms of the anti-malarial tender actually coming through should abet its earnings growth as well. So yes, if I have to pick and choose, large caps, probably yes, a bunch of those, but I think Ipca Labs would probably remain one of my favorite picks.
Ipca Labs would remain one of his favorite picks. Jay, as well as Mayuresh, appreciate your time this morning. Thank you so much for joining in. Markets on their part are running ahead. 10,760 is where you are at. Bank Nifty also up about 200 points. Broader markets are outperforming at the moment. At least the breadth is extremely strong. Sector